Hey everyone, me Kevin here. What happened today? We had a red day in the stock market, and we got to talk about a lot of the things that are developing, including what's happening in Shanghai. Get a little bit of an update on Ukraine. We got to look at some data and charts, really important. We're going to look at that short interest as well. Now, this video is brought to you by Public. Go to metkevin.com/public to get a stock worth up to $1,000. But folks, listen to this. This is only the second red day for the S&P 500 since March 14th, when I said, buy. Like, there's so little buying pressure, like, now's the time to freaking buy. I did the most buys on February 24th and March 14th. Super low buying pressure, great times to buy. But hey, can't time the market, I guess, right? Anyway, this is also the only fourth day that the NASDAQ has been red, and then red by any means, since March 14th. So in other words, like, the last 2 weeks have been really amazing. 4 red days on the NASDAQ, 2 red days on the S&P 500, that's nothing. And if you go all the way back to February 24th, which was another bottom for the NASDAQ, you'll find that we've been green 68% of the time on the S&P 500. That's almost 7 out of every 10 days green on the S&P 500. NASDAQ, since February 24th, has been a little bit more 50-50, at about 56% green, but it's clear here we're on a trend up. We're on a green trend, but why did we have this red today? I mean, yeah, that makes us feel a little bit better because when we put up the average candlesticks, like, we're clearly blowing up from March 14th. We go to the normal candlesticks. This is where we can actually count our couple red days over here, or red days since the 24th. We go over the NASDAQ. We can see the same thing. Got a few more red days over here, though a couple small red days that barely did anything, like a 0.25% down or 0.08% down. But I counted those, you know? The point is, we've been doing very good. I mean, this has been one heck of a rally here. So is this just a normal give back day, or what are people looking at in the market? Well, the first thing that people are looking at in the market right now that's creating a little bit of anxiety, and we'll talk about future things as well, is really Shanghai. But in my opinion, the Shanghai lockdown is actually not as terrible as it seems. The reason for that is they're locking down Shanghai in a very different way now. So they're locking down neighborhoods rather than just the entire city. In fact, what they're doing right now is what's called a two-phased lockdown. Phase 1 will be they'll lock down the eastern side, and then phase 2, they'll lock down the western side. So the eastern side will be locked down from Monday to Friday, and then the western side from Friday through April 5th. What's interesting about this is not only does that mean you're not locked down for that total of 2 weeks, you're just locked down for 5 days, but it also means that the ports are actually remaining active because they're not falling under the purview of those sides. So the ports have been active for 24 hours. Now, we have gotten pauses at factories. Like, for example, Tesla, we know, had to shut down for at least Monday of this week, and, you know, so far we're only at Wednesday. Speaking of which, by the way, I will be going to the Tesla Cyber Rodeo, and I'm going to have an announcement coming up about, well, I'm just going to give you a little preview, okay? I'm going to also be going to TeslaCon Texas. Like, if you go to TeslaConTexas.com, it's an event that's happening the day after the Cyber Rodeo in Austin. I'll be there. Sandy Monroe, Dave Lee, Galley, and so on. So if you're interested in Tesla stuff, go to TeslaConTexas.com. But more on them in a future video. I've got a Tesla analysis coming up, so I'll have more details in that video, so stay tuned for that. But they've only had their factory down 1 day here. And what's kind of interesting about this strategy is if you shut down some of the factories, in a weird way, you're actually giving the ports an opportunity to go, oh, no more boxes coming. Let's get this stuff out. You know, in a weird way, like, everybody's worried about the supply freaking chains, but in a weird way, you're giving the ports a little bit of a break because the ports are still going 24/7, so they can catch up a little bit without constantly getting all these new shipments, hopefully reducing port congestion a little bit. Now, why are these lockdowns happening? Obviously, COVID, 3,450 COVID cases. It's the most in any province in Shanghai. Of course, last year, remember, and this is, I think, why you start seeing some red in the markets. There are concerns that we might see a repeat of the Antian port getting shut down again, which is in Shenzhen, China, the 3rd largest city. Shanghai is the 1st largest shipping port, and this Shenzhen here is the 3rd largest shipping port, not city. And one of the things about last year that was so devastating was, remember the Suez Canal and how that ship got stuck there and everybody's like, oh my gosh, supply chains. Yeah, well, when we locked down Shenzhen, the supply chain disruptions were twice as bad as the Suez. That means twice as many vessels were delayed with the Shenzhen port shut down compared to the Suez Canal blockage. So it makes sense why there's some nervousness going on, right? But again, ironic because the ports are up, which is good, at least right now. Hopefully it stays that way. And maybe that'll allow some catching up, okay? Because the factories, or some of them, are shutting down. Anyway, then we've got some fears lingering about Ukraine. We had a lot of euphoria almost yesterday about, oh my gosh, in-person peace talks. This is it. This is that de-escalation we've been waiting for. But as expected, those peace talks didn't do much. If anything, they've kind of allowed Putin to sort of regroup, pull his troops back from Kyiv, as he said he would, but now he's kind of regrouping them in the eastern regions like the Donbass, and we know that one of Putin's demands is to essentially carve out the eastern regions in the Donbass, and he just doesn't want Ukraine to be part of NATO, but maybe would even consider allowing them into the EU. Who knows? The point is, we didn't get an end to this war yesterday during these peace talks. Now, we didn't really expect that. Personally, my expectation is that this war will be over by the end of May. Ukraine expects it'll be over by the beginning of May. We'll see. But at the same time, as you have these talks that didn't turn out as positive as hoped, although still a great sign, you have Germany now bracing for the potential that natural gas is just going to get cut off completely. Because Putin is demanding that any natural gas Germany buys be paid for in rubles, which, in order for you to pay for natural gas in rubles, it's not just like, okay, let me just like transfer the wallet in BTC to ETH or whatever. I mean, I guess in some degree it's like that, but you actually have to buy the rubles. So this means it's like, okay, here are euros, give us rubles, and now you have currency risk, because now you're hurting and depreciating, or you're holding an asset that's like falling in value. It's like a freaking hot potato. And it's like, okay, give me the natural gas. You know, if that takes a few days, that natural gas could end up being 20% cheaper if the currency fell 20% in those days. Now, it hasn't been as volatile, but it's certainly a risk. It's something that's being considered. So this is something that's frustrating European countries. It's another sort of negative thing that's going on in the markets. I don't see it as like that big of a deal. I think it's all solvable, but now there are rumors that Putin's going to say, well, by the way, you want Russian wheat? Rubles. You want corn? Rubles. You want neon? Rubles. I mean, quite frankly, you can't blame them. It's kind of makes sense. But anyway, so this is some of the drama that's going on in the market. Regarding data, we did have some, actually, in my opinion, not terrible data, but we did get a slowdown a little bit in personal consumption from Q4 estimates. And this is what I'm saying, like, it's still good, it's not terrible. We were expecting 3.1% growth in people's spending, came in at about 2.5%, so slower. This is from Q4, by the way, so it's kind of like an older piece of data. But Q4, okay, came in a little weaker than expected. GDP annualized came in at 6.9%. We were expecting 7%, a little weaker than expected, but honestly, not terrible. Now we'll see what happens. Q1 GDP, that comes out in April. Actually, it'll come out past April. It'll take a little bit for them to put this together, but that's more of a concern, is like, are we in a recession right now, right? That sort of look back. Private payrolls came in robust, strong, in a weird thing though, in a weird way here though. Good news in payrolls is kind of seen as somewhat bad news. So ADP reports come out 2 days before the actual jobs report. The actual jobs report comes out Friday. And the actual jobs report, if it comes in strong, like the ADP report came in, it beat by about 5,000, 455K versus 450. If that comes in strong on Friday, like the actual government report, the unemployment report, and the unemployment report does show that unemployment fell another 0.1% to 3.7, then that's going to, instead of being good news and be seen as a rally point, going to be looked at as like a, great, more fuel for the Fed to give us that 50 BP hike. So kind of got a little bit of that, you know, good news is bad news thing going on, especially this overhang of like, oh no, like what are earnings going to be like in Q4? How are companies going to guide? And I'll tell you, I mean, so far, Nike and Lulu, they reported really late in this quarter, and they're giving really good guidance. Like, I'm impressed. They're giving way better guidance than I thought they would give for this upcoming quarter here, Q1, which are the earnings that we're going to get next month and the month thereafter. So cautiously optimistic, but still a little worried that consumers are going to be rotating down or sort of turning that dial back on spending, right? So we'll get some other reports, but some important charts to look at. We'll look at these together right here. Are the following, because they give us a really good picture of some of the other drama that's going on in the markets. So first of all, we got the 10-2. Technically, the yield curve, at least according to the chart that I've been looking at for 10-2, did not invert. We're at a spread on the 10-2 here of just 3.6 basis points, which is really, really low. And if I zoom into a 3-day version of this is yesterday here where there was talk about an inversion. We got really close to that line there, but we didn't technically invert yesterday, which is good. And if anything, we're kind of spreading away from that, but not by much. I mean, 3.6 basis points. We're really close to inverting on that yield curve, right? And then, of course, over here, this is actually another piece of good news. So, like, let me just give a quick recap here. So far, a lot of these things, they're not terrible news. Like, I would say more good news than bad news with Ukraine. I'd say more good news than bad news with jobs, even though it could be interpreted bad. More good news than bad news with, like, the Lululemon report, for example, on consumers, right? That's good. On the inversion not happening, that's good. Yet could still happen, obviously, right? But I'm seeing more good news here than bad news. It's not like horrible news that is going to come through and all of a sudden tank our NASDAQ under that triple bounce that we had. And here's another example of that. So this is our inflation expectations chart, the 5-year break even. We've been seeing this skyrocket here, but look at this. We have a nice little drop in that market expectation of inflation. And this is really good. Like, in my opinion, for us to really see another, like a quad bounce, we would call it, on the QQQ, where we actually retrace all the way back down to 0% over here, which would be NASDAQ, somewhere around 320. It'd be losing about, 50 points. That's a huge move. It'd be giving up 15% again, ish, 12, 15%, somewhere around there. That's huge for the NASDAQ, right? Because that means, Tesla's probably down 25%, right? For us to really do that, when you look at the data, it's like, well, I mean, it's not great, but it's also not horrible. Like, yeah, okay, lockdown in Shanghai, but then you look at the details, it's like, okay, well, that's not that bad. Like, the news we're getting is not that bad. And so to me, it's actually consistent with us being at about a 50 to 60% retracement. Now, it would be stupid, absolutely stupid, if we ran all the way back to all-time highs. Like, that would be dumb. There's still too much bad news for that. But the bad news is not really getting worse right now, if that makes sense. So I think that's something to pay attention to. And in an interesting way, you've got the 10-year treasury yield here taking a little bit of a breather right now at 2.34%. This is good for mortgage rates. Remember, if real estate, and this is also interesting for the stock market, but if mortgage rates go up, then real estate potentially goes down. If real estate goes down, then spend could potentially goes down as that net worth feeling, the feeling of how rich you are, goes away. People spend less money, right? But it could also lead people to go more into the stock market because, hey, if real estate's starting to have potential issues, more people might throw their money and buy the dip in the stock market because we do still have a dip in a lot of sectors, right? The problem, though, is where people are putting their money is mostly, at least based on flows that we're seeing, the big boys. The institutions are seeing this sort of move to NASDAQ and sort of mega cap style stocks more so than smalls and mids. So smalls and mids, while they get these occasional like momentum surges for 1 to 3 days, it's the big caps that just keep getting bigger and bigger and bigger because it's almost like they're seen as a little bit of a safety tool. Like the most popular big caps right now, at least for retail, and retail's kind of been leading the charge, buying the dip in this here, retail's been focused on Apple, Tesla, Facebook, Nvidia, and AMD. Now, institutions are still somewhat bearish here, and we're going to talk about shorting in just a moment, but retail is not. I mean, we have $1.2 billion of retail inflows a day. That's as much as we had per day in March of 2021. That's crazy because people were way more active in stocks last year than they are today, but we're still seeing a similar amount of money flowing in right now from retail. So this is really good. Now, another thing for us to really pay attention to are potential bearish signals in the Bollinger Bands. And I'm going to show you exactly what I mean with those. But first, a quick message from our sponsor, Public. Public is an investing platform that helps people be better investors in public markets. Members can build a diverse portfolio of stocks, funds, and crypto within a single platform. And remember, if you use that link down below, mettkevin.com/public, you can get up to $1,000 of totally free stock. Remember, Public makes investing social, and Public puts investors first, and never making money from payment for order flow and ensuring that your trades are commission free. They also offer 29 cryptocurrencies and a beautiful opportunity for you to share your opinions about stocks within their social platform. So go check out Public, but go to mettkevin.com/public and you'll receive a slice of a stock valued up to $1,000. All right, so now we're going to talk Bollinger Bands and shorts. First, let me just hit shorts really quickly. People are still pretty bearish. I mean, take a look at this. Okay, I'm going to hide myself for a second here. Look at this. Okay, this is ARK in March. And we're at the highest point in shorts for ARK K right now. You look at SoFi, we're still pretty elevated. We're at a higher level of shorts in the last 10 days than where we were at the beginning of the month. Palantir, somewhat less, but still elevated, about 7.28%. Tattooed Chef, still over 30%. AMC, look at that. After the AMC and GME runs here, you've actually seen short interest jump, roughly about 5% each. Lucid, still sitting around 19% short. And then you go to the big boys. Look at that. SPY, 17.7% short. Pretty stable throughout the month here. And 13.5% short on the NASDAQ. Actually, less short on the NASDAQ than we are on the SPY, which is pretty incredible. But still, these are indicators here that markets are still somewhat pricing in protection here because they're nervous. Now, our Bollinger Bands, which I always like to use the TradingView platform for, show us that we are hitting these potential overbought areas here on, for example, Tesla. You could see us hitting the red Bollinger region over here, but this could be a little bit of a tough one to declare as a potential sell signal here because you have this new piece of data about this stock dividend, essentially the stock split, right? No sell signals here on Enphase, still not in that overbought Bollinger Band. Bitcoin, not in the overbought yet. QQQ, not in the overbought yet. Not in the overbought yet on this on the SPY. I know it feels like we've been nothing but straight up, but I mean, we're still mid-range here on the indices, on SPY and NASDAQ. Personally, I think we've got room to run here. If anything, Tesla, again, not the best indicator because of that split. If anything, Enphase or BTC are getting a little bit closer to touching these overbought bands over here. But beyond that, I'll tell you, the indices aren't showing us super bearish indicators, like no sell signals I see here yet, despite the fact that they're just being shorted. So I think on days like today, it's just people loading up on downside protection again, maybe institutions. Who knows? Some other news, by the way, that came out is that Biden announced that he was activating the Defense Production Act for lithium. This helped certain lithium miners rally, like LIC and Lithium America's company. And the SEC ended up responding to this rumor that there was a deal going on, that Chinese companies would have some sort of deal that would allow them to stay on U.S. stock exchanges without necessarily having to comply with the audits that the SEC is requiring. And Gary Gensler came out and said that, I don't know, quote, I don't know where this is going to end up. It's up to the Chinese authorities. And frankly, it could be a hard set of choices for them. So he kind of threw cold water on the idea that it's going to be easy for these Chinese ADR stocks, American Depository Receipts, to be safe here. So that's your BABA, your NEO, your XPeng. Now, it doesn't actually seem like the stocks really care about that. I mean, here's NEO. Yeah, we had some red the second half of the day, but quite frankly, everything was. Jump on over to BABA. Your same thing. That's second half of the day here. But again, that was really the entire market. I mean, I throw in QQQ over here, second half of the day as well. So I don't necessarily see any huge drama here. If anything, that tells me that the market's already pricing in a lot of risk that these stocks could end up getting delisted over the next couple years. So just something worth noting. And this is also why you've been seeing so much pressure on what I think are actually good companies like NEO and Alibaba. Anyway, check out metkevin.com/public, link down below. Thanks so much for watching, and we'll see you next one. Goodbye.